Okay, let's go ahead and get officially started. Welcome to today's webinar, which is titled The Three Most Effective Strategies for Managing Your Retirement Portfolio. My name is Jim Penna. I'm the manager of retirement services here at VectorVest, and I'm really excited about today's webcast. I hope you're excited as well. In fact, my promise to you today is this, that in this webinar, you'll see how you can build wealth, transform your legacy, and live financially free. Now, I know you probably get flooded with emails promising to help you with your retirement goals and objectives, and many folks who come are skeptical and thinking, go ahead and prove it. Well, we've been doing this a long time. In fact, VectorVest began, for those who are new here, way back in 1988. And in 2017, we began tracking a retirement growth portfolio, and it's averaged about 40% per year. And then we have a dividend growth portfolio I'm going to talk about that is up over 22% annually. That doesn't include the 50 grand, roughly just shy of 50 grand in dividend payouts that have been received, and nor does it include the power of reinvesting those dividends. So that's just the capital appreciation on a little longer term look about what we're going to talk about today and how you can build and grow your retirement. So that's what we're looking to do. We had one of our clients, Jerry. He told us all about his ability to generate a consistent monthly income. Now, after going through our training, he went from being hit or miss with his trading and having no methodology to being able to generate an extra 2% income each month. Right? So this webinar is built on results, and I want to show you the system that we use to achieve these results. So if learning how to do that sounds good to you now, I'm just going to ask you to try to turn off your distractions. Close your door, turn off or at least put on vibrate your cell phone. Close down other windows on your computer, whatever you have to do not to multitask. I want you to stay focused because I think there's some really good information here that could make a very big positive impact on your life, frankly. So I'm going to start here. Here's how to know if you're in the right place. Okay, so you're in the right place here today if you're worried about the next market collapse wiping away a good chunk of your nest egg, and it's causing you to be so conservative that you're not getting the gains that you see others getting. You're in the right place today if you want to grow your account steadily each year, but it seems like every time you buy a stock, the market or the stocks that you chose are going down and you feel like you're just spinning your wheels. If you don't have an income source that is as steady or as big as you need it to be, and that's causing you to scale back your lifestyle and not do the things you want to do, then you're in the right place today. If you fear you won't be able to retire when you want and that you might need to rely on others or take care of you, and then finally, you're in the right place if you might be one of the many people who are either over age 65 or approaching that, and you may have to continue to work, not because you want to, which is great if you do, but because you have to. Okay. So let me ask you guys, and we'll start interact. Does any of that ring true for you? Does any of that ring true for anyone here? Yeah, and like I said, it takes a second. Yeah, yeah. So a lot of people are typing yes in. It takes a second, but they start to pour in. Yeah, I mean, some form or fashion of those things, are part of everyone's, worries, I guess, for lack of a better word. Um, but with all those yeses coming in, I can tell you guys, I think you're in the right place. Today, after decades of working with retirees, we believe we've identified the root cause of the problems. And in fact, what I call all of those things are symptoms of the real problem. And the real problem is that your retirement investing model is broken. We also believe that it only takes a few minor tweaks. You can get it fixed. And once you've fixed it, you could be back on solid footing. And that's what we want to do here today. All right, so the model we use and what we have proven to work is what we call VectorVest's 3Ps investing model. All right, the 3Ps are profit, provide, and preserve. So what do we mean by that? When you think of profit, you can always think of the word growth or capital appreciation, right? The portion of your portfolio that we're going to gain capital appreciation. The plan is to grow with safe quality stocks rising in price in a rising market. When you think of provide, simply think of providing income. It's just a system to generate a safe, consistent income. And when you think of preserve, think of the word protect or insure. Preserve is a protection plan for your net worth. And in my opinion, the most important P that we'll talk about. Okay. So remember my promise from earlier to build wealth, transform your legacy, and live financially free. Well, to do that, you need to be able to grow your investments, generate safe income, and most importantly, preserve your capital. And we believe when you do all three of those, that's when you're able to achieve financial freedom. So the first shift you need to make is to shift from not being in control of your own retirement to where you decide to take control of your retirement. Right? That's the first step, is that you have to decide to do it. So we always talk about, after all, who cares more for your money, you or someone else? You think you've done that you won't have the time to be able to do all of this or the skill. Well, you're going to see today that you can do it. It doesn't take a lot of time. You'll have the knowledge at your fingertips here, and I'll show you how to leverage off others. I'll talk about what that means in a minute. So you don't have to do everything on your own. But you're here, I think, because hopefully you have decided to take control. Now, I want to start by looking at the 7 signs that your portfolio will not be ready for retirement. So even though most people do say they care more about their money than anyone else, what do most people end up doing? Well, here are the signs that you won't be ready for retirement. And first, most people will count on Social Security to provide the income they need to retire happily. Now, that alone has many problems. Right? 60% of non-retired workers right now feel Social Security won't even be around when they retire. And even if it is still around, the Social Security website itself states that Social Security was never intended to be someone's sole source of retirement income. Right now, the average Social Security benefit is just over $1,500 a month before Medicaid premiums are deducted. So on average, you're left with about $16,000. These are average numbers I'm talking about. So obviously that's not enough. So what else do folks do when they're planning for retirement? Well, a lot of people just save their money, right? You put your hard-earned money away, counting on it to be there when you retire. However, with interest rates so low and really not expected to rise all that much anytime soon, I mean, eventually they will, but not anytime soon. Inflation is actually higher than the interest that you're receiving. So by saving your money, you're actually losing money because your dollars are being devalued. Of course, there is the set it and forget it approach. These folks put their money into mutual funds, IRAs, 401ks, and hope for the best. But unfortunately, when the market drops and wipes out 40 or 50% of their net worth, many people end up delaying retirement or may even have to go back to work if you're in retirement. And then finally, when all else fails, you can always play the lottery, right? I remember there was a commercial that advertised the lottery. It said, all it takes is $1 and a dream. Well, unfortunately for many, that $1 turns into 2, then into 10, then into 50. And sometimes you end up spending a few $100s a month on those dreams. And believe me, that's really not your best retirement plan. Another sign you may not be ready is that you feel you can go out and hire someone to make the decisions for you. That's what one of our subscribers, Rob, did. He retired in 2005, and as we all know, the financial crisis hit in late 2007. And he wrote to us, he said he'd used professional advisors for direct shares and a few managed funds to build up their retirement portfolio. He said those advisors told him to ride it out, and by mid-2008, our portfolio had lost 40%. Our retirement plans were in ruins. Total despair, and it looked like we would have to go back, come out of retirement, and go get a job. It might not be as dramatic a drop like Rob, but Carol described another typical result. She hired an advisor in 2013 to help manage her inheritance after her father had passed. And she said by 2017, she finally had the time to take an in-depth look at what they were actually doing. And she said she was shocked. It was a mishmash of cookie cutter funds. And this is what drives me crazy. After their fees, the net result was only 1% annual return during a time when the market did much better. A lot of folks will just go out and spend less, right? You end up tightening the wallet and spending less. If you're cutting back on your spending because you're worried, that's another sign your portfolio is not ready for retirement. And then finally, if you decide to work longer than you originally intended, now if you choose to do that, that's fantastic. But if you do it because you have to, it typically means your retirement portfolio is not ready. So if you notice, there's a theme here, right? If you're exhibiting those signs, it's a clear indication that you do need to take control. Remember, there are hundreds of thousands of people out there just like Rob and Carol who trusted their money to people who thought they were more knowledgeable and more skillful, who ended up losing 40 and 50% of their retirement savings and not coming close to the gains they had hoped for. So even if you have somebody who's managing your money, you need to pay attention. The strategies we're going to talk about will give you techniques to both manage your own money as well as give you the information you need to watch over the work done for you by any other manager. So as we go through the strategies, I want you to see how they are all things that you can do. Right? And it doesn't take you much time. So let's go ahead and jump into it. All right, now that you've decided to take control, the first thing you need to do is protect your assets. So the first, I'm going to talk about preserve first. Okay. You can't grow your portfolio if you can't protect it and preserve it. That's why I'm using the preserve P first here today. Right. Instead of worrying about the next market collapse wiping away your net worth, you need a strategic defense system to protect your assets. Now, a lot of people get caught by surprise when the market drops. After it happens, you hear the people on TV and advisors talk about what you should do now to try to make your money back, which also never made sense to me. Right? Instead, you need to know when the market is toppy, when it's time to be proactive, and how to insure yourself. So here's a look at the market in this broad view since 1999. Now, let me know in the chat box if just so we can keep interacting. Let me know in the chat box if you ever bought or owned a really good stock and watched it drop when the market dropped. Right? And I'm not talking about any old stock, a stock that you thought was just, top flight, this company makes money, and then you're left scratching your head as you watch it drop. Now, we've all been there, right? So, a lot of yeses coming in, right? I know you got many times, Richard says. We've all been there. All right, let's zoom in on a few of the biggest market moves that have crushed a lot of folks over the years, and I just want to make a point here about how important market timing guidance is. So I'm guessing there are people in the room today who may have held stocks or managed funds through the bursting of the dot-com bubble. I remember I was working on a trading desk at the time, and I remember it very, very clearly. Right. Now, one of our customers, Lynn, during the dot-com boom, said he took 80 grand and increased it 5 or 6 times over. But in 2000, he proceeded to lose almost everything over the next 2 years. And using his words, he was angry or pissed, and he needed someone to blame. Right? He needed someone to blame. Here in the 2008 housing bubble burst, right, the average mutual fund fell over 40%. And many people were like Robert, who we heard from before, who he lost 40% of his retirement and thought he'd have to come out of retirement and go back to work because he wasn't ready for that kind of sell-off in the market. And just last year, we know that the S&P 500 dropped 34% in this very short time, this time on the pandemic sell-off. So I'll ask, how many of you had your financial advisor call you leading up to any of these events to warn you? Right? Okay, I doubt there were many calls for that period to get you out, but after the event passes, you might get a call saying, "Oh, by the way, we're down a bit, and here's maybe what we can do now." Okay, which brings us to today. Many are worried about the next market collapse. Some people say you can't time the market. Okay, well, the truth is you can. What you can't do is predict the market. You can't predict the market. What we can do is analyze what is going on and recognize market trends. And even though the markets on a daily basis may have ups and downs, if you look at the big picture, you can clearly see major trends. You can even see the smaller trends within the bigger trends. Right? Surprisingly, you don't hear a lot of this information from talking heads on TV. They rarely would say, hey, it's time to get out. The market's in a downtrend. So I want you to be careful where you get your information. It's good for their business when people are investing in the market. Advisors still get their fees whether the market goes up or down. So you need to be careful where you get your information. So let's look at how to use the right information so you'll never be on the wrong side of the market for more than a week or two. So what you're about to see will ensure your portfolio never collapses again. Okay? You want to make sure you have a system that allows you to determine the market's direction. Right? Some people use things like moving averages on the S&P 500, guess which is fine, but I use the guidance from VectorVest. Whatever you do, I suggest you don't listen to the talking heads on TV. Instead, you should have a system which is not emotional, which is based on empirical data and has an historical track record. So again, let's take a look at a few of the market moves we talked about earlier and see what happens when you have the proper market guidance. So let's start by looking back at the dot-com bubble. Every night in our daily color guard report or in our timing the market section in the VectorVest program, we have guidance such as this. So back on March 17th of 2000, about a week off the peak, we said, I believe the rally is exhausted. Downside risk outweighs upside potential. Prudent investors should protect profits and take defensive actions such as buying puts. I'm going to talk about a little bit later. That's tremendous guidance. Were you investing back then? And would that have been beneficial to you? Let's fast forward to the next big market collapse. This is around the financial crisis, the housing bubble burst. On November 2nd, in 2007, just days off the market top, in the essay, Dr. D wrote, a word to new subscribers. The confirmed down signal that we received yesterday could be the entree to a long bear market. Okay, he went on to say that don't be deceived by the endless parade of experts who will appear on TV and other places telling you to buy stocks. This is not the time to buy stocks. Okay. Would that guidance have helped you protect yourself then? If we move to the most recent drop, the big drop, which just happened last year, of course, back on February 14th, just days before the peak even, we noticed warning signals in our market timing indicator. And we said that the price of the composite continued to move higher this week, closing at a new record closing high. However, as the price hit a new high, the buy-sell ratio closed lower. To add to that, if we look at a 3-month market timing graph, we see that the BSR, RT, and MTI, and if you're not familiar with those are our proprietary market timing indicators, so don't worry about it. Just know our indicators had closed higher week over week, but they were at lower levels on that day than they were during the January high. That's what we call a bearish divergence, and it suggested that downside risk outweighed upside potential. If that sounds familiar, that was the same idea back in 2000, and we all know what happened. And just a week later, we said prudent investors should not buy stocks at this time, and aggressive investors and traders should play the market with a bias to the downside. So I'll just ask, would that have been helpful to you? You can just type in yes or no. I want you to interact. Okay, understanding the market trend, and there is a huge difference between predicting the market and timing the market. Okay, we recognize trends to put the highest probability that we can on our side to be right. That's the difference between predicting what might happen 6 months from now or 2 months from now and recognizing trends and acting on it. Okay. All right, let me show a case study of a portfolio insurance trade. This is how you would protect your overall portfolio. There's ways you could do it on individual stocks, but let me show. I'm going to talk about back in 2018. Now, this is one of the drops that were not in the ones I just talked about. But there was another big market drop towards the end of the year in 2018 that I remember very well. I know in this day and age it's an eternity ago, but it was October of 2018. If we zoom in, and you may remember it because it's the fall that went all the way right up to Christmas Eve of 2018. Okay, so I'm going to zoom in one more time to that same time frame. So near the beginning of October, our system signaled that we were in a confirmed down call, our most conservative look at the overall market, recognizing a trend. Okay. As a retiree or someone who wants to protect their net worth, that's a great indication to become defensive and initiate portfolio insurance. Okay, so you become defensive. A strategic defense plan says I'm going to protect my portfolio. And in this case, we're going to use the SPY and buy put options on that. The SPY is just an ETF that tracks the S&P 500. So if the S&P 500 continues to fall as it did, the value of the put option would increase in value, offsetting some of the losses on the stock portfolio. Okay, it's an insurance policy. A put option rises in price when the underlying asset falls. Just like if you owned an asset that was damaged and you had an insurance policy, it offsets the losses. It's the same thing. In this theoretical trade here I want to talk about, let's assume you have a $100,000 portfolio. The basic equation that we use for the number of put options to buy on the SPY, for a $100,000 portfolio, it's usually 3, maybe 4, depending on your level of defense that you want to put on. But basically 3 put options will do it. An at the money put on the SPY, or roughly at the money. In this particular case, if you had bought one using closing prices on this date, you would have paid about $604 per contract, or $1,800 for insurance on your $100,000 asset. Okay, and think about it this way: how much do you pay each year to protect your car, to ensure you're paying car insurance? And listen, I don't know, maybe it is, but most likely your car isn't worth 100 grand. Let's see what happened. As it turns out, it's a good thing in this case the protection was in place, because if we use the expiration date, your put would have profited over 11 grand, almost $12,000 would have been the profit. So while you might have incurred losses in your portfolio, the put you place has offset that and protected you from your portfolio collapsing. And even if you had closed the trade anywhere in this range, you still would have garnered a very nice profit and mitigated your losses very nicely. A client I work with, his name was Elaine. He wrote to me about a portfolio insurance he placed at the beginning of 2018. Now this was the beginning of 18. Well, we've been talking about it for years, but he said, Jim, because of your teaching, I hedged my portfolio at the end of 2018 in January, the end of January of 18. And he bought the SPYs. He invested just $835 as an insurance policy. The market cratered. He sold his puts, and he had a ridiculously large profit of $23,000. His portfolio was not only saved, but brought it positive. So how much would this have benefited you during the market collapse? I want you to take a second and just think about that. If you had the proper guidance and took the proper steps. I'm going to take a quick sip of water. And yeah, there you go. Okay, excuse me. Yep, takes a minute for him to come in, but yeah, it would have been awesome, right? It would have helped save money. Would have been, yeah. So yeah, we would go in. You'd buy roughly at the money, maybe slightly out of the money. You'd go out anywhere from 30, 60 days, maybe 90 days. Okay, the idea is that you have to be strategically defensive at the right time, and we'll talk more about that later. So The strategic shift here is that you need to go from worrying about what could happen and being unprepared when it happens to where you have a strategic defense system in place which protects your hard-earned assets. Protection is an important part of retirement investing in this model, and it's how you'll be able to build wealth, transform your legacy, and live financially free. All right, let's move to the second P in our retirement investing model. So we're going to shift gears here a little bit, and we're going to go to the profit portion of this. We're going to talk about growing your portfolio. Now that you have a strategic defense system in place to protect your assets, you no longer have to be so conservative when investing, and you can take advantage of market upturns to grow your portfolio. Okay, in the past, you might have been plagued by buying stocks that didn't go anywhere or were too volatile, causing you to spin your wheels, as we talked about before. So we need to have this mantra in place of buying safe stocks rising in price only when the market is rising. And so for our retirement account, we want to look primarily at a stock safety more so than anything else. So it's very important. We're not being speculative here. Right? We're not trying to hit the home run on any one stock. While it's fun to hit a home run, for any baseball fan out there knows what home run hitters do when they don't hit a home run, and that is they strike out. Right? We don't want to strike out in our retirement portfolio. Okay, so what happens to folks who are trying to hit the home run? They go out and they end up trading in a way that is totally different than who they really are and what their goals and objectives really are. And there's nothing worse you can do, especially in your retirement portfolio. So if you're not seeing the returns you want, the answer is not to go faster or try to become a day trader or just short-term trader to make your money back. I use the analogy when, my kids are a bit older now, but when I was teaching them to drive, if they were having a hard time at the beginning, I didn't tell them, slam on the gas. No, I told them to slow down. And you should do the same thing. It all starts with this quote from our founder and mentor, Dr. Bartolito. He said to me, and it's taught me many times, good portfolio management starts with buying the right stocks. Right? It's just like a team, like a sports team. Right? If you put the best players on the field or on the court or on the ice, whatever game you want to envision, right? If you put the best players on the field, you have a much better chance of winning. So by filling your portfolio with really good stocks, safe stocks, just those good stocks alone are going to, again, help put the probabilities in your favor. So what do we mean when we say safe stocks? Let me share a checklist of what we look at when we're talking about safe stocks, with the factors that go into it, and I'll just go through these briefly. Earnings consistency. Does the company make money quarter over quarter, year over year? Right? Consistent and predictable financial performance is what we talk about. The company size. How big is the company? Doesn't have to be a big company to be safe, but we take that into account. The price volatility of the underlying stock is taken into account when we calculate our safety criteria. Debt to equity ratio. Is the balance sheet favorable for a company? Can it stand any headwinds because of something maybe specific to the industry or the overall economy that could hurt companies? Well, a strong debt to equity ratio or a strong balance sheet means that the stock is safer and more likely to weather those storms. How long has the company been around? Right? Better the devil you know than the devil you don't, Dr. D always said. And then finally, dividend history. A good quality safe stock doesn't have to pay a dividend, but if it does, it darn well better continue to pay it, and not only that, but grow that dividend. Okay, so it's a very important factor. So what I'd like to do is I'm going to actually jump into the VectorVest program here, and I want to talk about the power of relative safety and illustrate it for you. So from the home page of VectorVest, I'm going to go to the main toolbar and I'm going to choose the Viewers tab. And in the Viewers tab, I have set up here in my watch list viewer a list of stocks that I created. I'm going to break this down so we have a little more room for you to see. I created this list of stocks, and they're just well-known companies. There was no real rhyme or reason here other than putting this list together, made up of places where you shop, where you eat, where you drink, where you spend your money. So if you don't own these companies, you're probably a customer of most of them at some point. So that's where this list of companies come from. Okay, and you'll see Target, Microsoft, Apple, Lowe's, right? I'm sure we've all, placed orders on Amazon and had a Starbucks coffee. So you get the idea of where this list came from. Okay, so that's kind of the idea here. Now, this list of it turned out to be 41 stocks. This is not just randomly placed here. These are sorted by the VST flagship indicator called the VST, or the Value Safety Timing Indicator. Right? We combine fundamentals and technicals. It gives us the VST. We're able to bring the best overall number to the top on a 0 to 2 scale. Okay. So from here, what I'd like to do is just illustrate the power of relative safety. If I click on the RS tab, what it does is automatically sorts these 41 stocks with the highest RS stock, or relative safety. Again, the consistency and predictability of the financial performance of the company on a 0 to 2 scale. So now we have that top of the list. What I'd like to do now is go to this local toolbar here and choose Quick Test the top 10. Okay, well, actually, before I do that, I'm sorry. I'm going to change the date. I'm going to test these stocks. So this is as we speak. This is live. If I click in that date box, I'm able to take these back in time, just again, illustrate the power of relative safety. I'm going to go back. It's almost 3 years now. Okay, January 2nd. I have portfolios that are built from this date. It's a date that gives us the ability to look back in time and say, okay, we had uptrends, we had downtrends. This is through the pandemic. How do these stocks perform? So as you'll see, we are sorted by the highest RS stock, and I'm just using the beginning of January in 2019. I have the ability to choose Quick Test, and now what we see is from point A to point B, the close of the second to right now, we're looking at stocks that are up over 82.5%. You can compare them to the S&P 500, so performing right along with them. That's the power of high RS stocks. All winning trades. Again, no money management techniques in place, by the way. Let's close that, and now I'm going to click on RS once again, and that's going to sort these now with the worst relative safety number coming to the top. Right? You'll see the top 10 are all below 1. Right? Still well-known companies, but not as safe. If I quick test those stocks, right, from January, from the exact same time frame, you'll see that they're still up, still almost 31%, but well below the S&P 500. 4 losing trades out of this, again, with no money management techniques. So that's a quick illustration just out of these well-known companies of the power of relative safety and how they perform. What I'd like to do real quick is I'm going to go into the stock viewer for a moment, and this is going to bring up all roughly 9,000 stocks that we currently track. Okay, and it brings us back to current. And what I'd like to do, again, just for illustrative purposes, is to bring us back to that same date, on January 2nd, hit OK, and sort by relative safety. So back on that same date, and the reason I'm doing this is because, okay, I had a list of 41 well-known companies, but VectorVest has a much greater reach than that. So now I'm looking at the best of the best out of 7,000 stocks, and I'm sorting them by relative safety. And if we go ahead and quick test those top 10, that's a significant amount to outdo the S&P 500 over that same time frame. All winning trades. It's fun to click. The sort them by percent price gain is fun to do. If I click on the top stock and right click, and I bring up a stock graph, maybe the best way for me to illustrate the power of relative safety is this. This is a 1-year look at a top relative safety stock, and it's got the price of the stock up top and the earnings per share growth down below. That's a 1-year graph. Let me change it to 5 years. Okay. This is not a coincidence that the price of the stock continues to rise, as do the earnings per share continue to grow. Okay, these are the type of stocks that I want residing in my retirement growth portfolio. And when we're able to do that, okay, this is the type of equity curve that we can expect. Now, this one began back in 2017. This portfolio from this screenshot is actually up over 200% at this point, putting in the proper plan to be able to do this. And just real quick, I know there's drawdowns like in 2020, and I'm going to talk about how to mitigate those in a moment. Okay. So we're able to do that with proper retirement growth portfolio. That averages over 40% a year in this particular look. So I don't know if you're familiar with the rule of 72. If you make 10% per year, it would take 7.2 years to double your money. At 10% a year. At 20%, it takes 3.6 years to double your money. And if you make 36% per year, it would take 2 years to double your money. Okay, imagine that. And so you might say, well, what are you doing, guys? Are you rigging this? Is it rigged? And the answer is yes. Right? It is rigged. It's rigged in your favor because you're buying good quality, high IRS stocks in a rising market. That's how it's rigged. Okay. So let me ask you, if you could double your money every 3 years, which this one actually tripled in just over 4 years, buying safe stocks, how would that affect your retirement? What kind of impact do you think that might have on your retirement? Go ahead and type it in the chat box. Yeah, and there, it takes a second to come in, but yeah, Peter says pretty darn good. Galen says a bunch. John says primo, positive. It would be awesome. Who wrote that? Sleep easy. Gary said sleep easy. I like that one. So yeah, I mean, these are the type of returns that we can see. So another shift you need to make is to go from slow and stagnant growth to where you have a solid growth portfolio strategy that has you buying good, safe, quality stocks so that you can have steady growth. Okay. Now, as I showed, there will always be drawdowns. Nothing goes straight up, but we're going to talk about mitigating those in a minute. So this is another important part of your retirement investing model, the growth side, which will allow you, again, to build wealth, transform your legacy, and live financially free. Which brings us to our third P, which is provide. And here we're going to talk about generating income. So again, we're going to shift gears to generating income. Remember, you don't want to rely on your pension or Social Security to carry you through retirement. So in order to continue living the lifestyle you're used to, you need to open up new income streams. Right? New income streams. And there are two ways I want to talk about that you can do that. Number one is get paid with dividends. Okay, one of the benefits of focusing on safe stocks and the proper dividend stock is that they typically pay a nice dividend to the shareholders, and they give you capital appreciation as well. So we want to capitalize on that. Now, I know before I go into it, everyone knows all about dividends, right? But finding the best dividend paying companies for a lot of people is not the easiest thing to do. Because what will happen is they'll often look for the wrong thing. So if you Google good dividend stocks, as I've done here, you get, 850,000 results. But what you're going to find always is that they will just simply show you the highest dividend yields, which is just the absolute wrong way to go find a good quality dividend stock. Right? Are they good companies? Are they safe companies? I have no idea. NASDAQ.com, you get something similar, right? And you can't really see them here, but they sort it by the highest yield. But we don't know if the company's safe or if the dividend's safe. So here's how we do it at VectorVest, right? So inside the software, there are several pre-built watch lists for you. So what I have here in our dividend payers portfolio or search folder here under the watch list viewer, DRIP stands for Dividend Reinvestment Plan, and you'll see all the different ones that are pre-built. I usually just skip right to the 25 plus. What does that mean? It means 25 plus straight years of higher dividends. Not just paying them, but growing them. Some of them for 60, 70 years or more. Okay, and again, they're not here randomly. They are sorted by the VST. That's our default sort for most of these things. And you can see West Pharmaceutical. Now, this is just from about a week ago, this screenshot here. Nucor, Lowe's, T. Rowe Price. Again, you'll recognize so many of these names here. Right. Let's look at a graph of the top stock there. This is West Pharmaceuticals. Notice how the dividend continues to grow each year. And by the way, just in case you haven't noticed, that's like a 26-year graph here. The price of the underlying stock continues to grow. The dividends grow because the earnings have grown. Okay, one of my favorite stocks, I happen to own this stock there. These are the type of stocks you want to add into your dividend growth portfolio. Okay, if you pulled up a graph of T. Rowe Price or Target or any of those other stocks up there over the long term, you'll see very similar patterns. That northeasterly direction of dividends, of the price, and if you had earnings on here, the same way. So what we do, just like we did in the growth portfolios, we have our dividend growth portfolio. Okay, so not only are your dividends being paid and growing, but you're also getting capital appreciation out of this portfolio. Now this portfolio is up, again, this was from a week or two ago. It's up over 190% right now. It is a little longer term look because it's important to understand this is, uh, we're not day trading these or swing trading this. So the important idea is to look long term at the returns that you get. And as I said earlier, this is nearly tripled. Now this is just under 8 years, about 7 years and change here, or 8 years and change, I should say. But that doesn't include nearly 50 grand of dividends that I've calculated out, and that doesn't include reinvesting those dividends if you choose to. Right, so that's roughly $5,800 in income each year just through dividends on a portfolio that began with $100,000. That's just under $500 a month. So you have to ask yourself, would an extra $500 a month be helpful to you? I know it is to me. Okay, so that's the power of finding the right dividend stocks with the proper characteristics that a quality dividend stock has and having a plan behind it. So the second income stream I want to talk about, the second source of income, is similar to what we call collecting rent from your stocks. Right? You want to think of it as charging rent to stocks that reside in your portfolio. So we're going to talk about using one of the safest, most popular option income trades available. Right? It's so safe, it's the main option trade retirement accounts will allow you to do. Most IRAs now and most of the mainstream brokers allow you to do option trades in your retirement account now, but for the longest time the covered call was the only one you could do a long time ago. Selling covered calls is an excellent way to generate some income. And let me just walk through quickly how a covered call works. And just remember, you don't have to be an options expert to do this. It's the most basic, most popular income trade there is. Okay, and here's how it works. So this is just ABC stock at any given time. It doesn't matter. Stock's trading at $176 a share. Instead of just owning the stock and hoping that it goes up, you can sell a covered call against this stock. What does that mean? In case you are new to options, again, you don't have to be an expert, but if you own or simultaneously go out and buy at least 100, it's got to be 100 shares of stock, you can go out and sell a covered call. And all that means is that you're selling someone else the right to take away your stock at a higher price at a later date. Right? Someone else is buying the right to purchase your stock at a higher price at a later date. And they're paying you to do that. Okay, so what would that look like? Well, if I own the stock at 176, I can sell someone else a call option, which gives them the right to buy my stock at 180 bucks. And for that right, they're going to pay me $1,000, $1,033 or $10.33 per share for one contract. What could happen? Well, the stock could go down, of course. The profits from the call option that you sold gives you a cushion. In other words, it lowers your cost basis. That would give you some room to the downside before you began to lose money. In this case, the stock go down $10.33 before you hit break even. And you'd have risk management techniques in place just like you would if you owned because you own the underlying stock. Now the stock could go sideways, and that's great too. You could keep the $1,000 plus you can sell another covered call against the stock because you still own it. And then finally, if the stock goes up, you could make what's called the max profit. Right? You would keep the $1,000 that you got and the gains in the stock up to your strike price. So all that means is you'd keep the $4 in capital appreciation plus the $10.33 premium if your stock was what would be defined as called away, right? You'd have to sell your stock at 180, but you'd make over $14 a share. Okay. So in fact, if you remember from Jerry earlier, we talked about prior to learning this income strategy, he told us his investing was hit or miss and that he had no methodology. What a how how rough is it to explain your retirement income strategy as hit or miss and having no methodology? But Jerry knew what to do and he fixed it. He went from hit or miss and no method to consistent monthly income. Okay. So this time I'm going to ask you two questions. How many extra income taps do you have now? And by taps, I mean, you open up the water tap and the income flows, is what I mean by that. How many do you have right now? And if you had these open, what would the extra income allow you to do? Or maybe allow you what to stop doing something. So if you want to type that in real quick just to keep us moving. Robert says he's got 3 taps. Robert, I'm going to guess dividends, covered calls, and credit spreads. Am I guessing right? Okay. All right. So when you implement the provide piece of your retirement investing model, you'll be able to shift from not having enough income to where you have a steady flow of consistent income, which will allow you to continue living the lifestyle you're used to or that you deserve in retirement. Okay. So I think you guys came here for a couple of reasons today. There may be a few reasons. Maybe you're worried about that next market collapse, wiping away a chunk of your net worth, and it's causing you to be so conservative that you're not getting the gains you want to see. Maybe you came here today because you want to grow your account, but you find yourself just spinning your wheels without the proper plan in place. Maybe you came today to figure out how to generate enough income in retirement. Maybe you fear you'll have to scale back your lifestyle and you might not uh, be able to do it on your own. You may need the help of others. And maybe you're doing okay right now, but you're just not quite where you want to be. And this may be the reason you're here for sure. You're not where you want to be, but you have no plan to get there. Anyway, today I hope that you learned it's possible to take control of your retirement when you have a clear plan, that you don't need to be worried about a market collapse when you understand how to place your strategic defense trades, that you can see steady growth in your portfolio by using a solid growth strategy, and that you can generate a consistent income with new income streams using dividends and covered calls. And the main thing I hope you learned today is that the secret to build wealth, transform your legacy, and live financially free is to make sure your retirement investing model includes the 3 P's of profit, provide, and preserve. So that brings us to the obvious question that you might be asking right now. How do I create this type of system in my retirement portfolio right now? Well, I believe you have a choice. You can choose to do absolutely nothing and keep doing what you've been doing. But you know the old saying, the same old thinking leads to the same old results. My fear is that you'll be in the exact same place this time next year, worrying if you'll have enough money to retire. Now you can choose to do it alone, maybe put together some of the things you learned today and learn by trial and error. But mistakes of course can be very costly. Or you can choose to do what I did, what Jerry did, and thousands of others have done, and that is get right to the solution now. Why do all the work on your own when there is training available that allows you to bypass all that trial and error and get to success much faster? So instead of taking the long way around from where you are to where you want to be, learn how to take the shortcut. That way you get your retirement on solid footing as quickly as possible. So what I want to do is give you the plan that if you and I were to work together for 5 weeks, literally you and me in a room every week for the next 5 weeks, here's what I would get you to do. Right? And it's a simple plan called the Retirement Portfolio Transformation. Before I get into the retirement portfolio transformation, I just want to point something out quicker. Albert Einstein said that everything should be made as simple as possible, but not simpler. So it's important that you understand that this is not a get-rich-quick scheme. It's not some magic pill where you should expect results, in the next 24 hours. This is serious and it requires some effort on your part. And if you're not going to commit to it, then don't do it. It's not for you. And you, thanks for coming, but you can log off now if you're not ready to put at least some work into it. So we say this is for serious people who take their retirement seriously and who are willing to put that effort into a system. But this is why VectorVest was created and why we have put together this retirement portfolio transformation for you. We put it together for you, for people who want a simple plan to set up their portfolios for success. The system works, but you got to do the work. Right? There's no magic pill. Right? So by transforming your portfolio, we believe you'll be able to live up to the goals that we talked about earlier. It's a simple plan called the Retirement Portfolio Transformation. And usually it's easier for me just to explain the course real quick and map it out for you. We have 5 modules that make up the Retirement Portfolio Transformation. They all, of course, take into our investing model here. The course will guide you through the 3 Ps. The first is the Retirement Foundation Builder. It sets up clear goals for you. Right? You cannot succeed without your goals and objectives being in place. Always remember the old saying, a goal without a plan is just a wish. Okay. So in this module, we'll talk about treating your investment as a business, setting what's called the SMART goals, and creating a vision statement. Very important to your success. Next, you'll learn how to increase your capital with a safe growth portfolio. We'll talk about profit, how to steadily grow your portfolio every year. If you want to do that, you need to fill it with the right stocks. In this module, we'll show you a tried and true process, a full investment plan so you can complete your profit transformation. And then in module 3, we'll begin the provide transformation. Right? We'll switch to provide and generating income. We'll focus on dividends. Right? A source of income every retiree should take advantage of. But remember, not all dividend stocks are created equal, and the last thing we're going to do is just simply chase the highest yield. We're going to find the best quality candidates, and we'll teach you how to manage them once you build that portfolio. In Module 4, we'll complete your provide transformation, right? The second part of income, by teaching you 2 of our go-to option income trades. Not only are we going to talk about selling covered calls, but we're going to address selling put options as well. It's a very similar trade to the covered call. The P&L profile is the same. We'll talk about the nuances of that as well. Okay. Even if you've never traded options, even if you've never traded them, you do not have to be an options expert. We'll walk through the basis. It is my opinion, in the 30 years or more that I've been doing this, that if you're going to build and manage your own portfolio, understanding a covered call, and then what we do in Module 5 is the protective put. If you don't, it's essential that you understand those 2 option trades. Again, you don't have to be an options expert, and we're going to walk you through exactly how to manage those trades. So you don't, as we showed, you don't want to be unprepared and not know what to do when the market turns against you, so that we can mitigate any drawdowns. So in this module, we'll complete the retirement transformation by teaching you how to preserve your net worth. Okay, so by learning all this at the end of this course, you'll know how to grow your account, generate income, and protect your net worth. So if I were to work with you, if we were to do it, literally just you and me together, we talk about the value of the course. It would be $29.95 if you broke all of those things down. Okay, in the retirement portfolio transformation, the full course, again, $29.95, but we do have bonuses that go along with it. Okay. We have live mastery sessions. My favorite part of these courses. Um, in those live sessions, I'll take a look at the things you're doing and the questions that you might have and guide you through the entire process. It's where we actually implement the ideas and techniques that you learn in the modules. And if you can't make the live session, don't worry. You can submit your questions ahead of time to a dedicated email, a private email address that we give to you for joining the course, designated just for our students. And not only that, but you get an archived recording of the live session. So you can send us an email. If you know you can't make a live session, we'll answer the question during it. During the mastery session, you'll be able to go in there and answer it. Plus, as an added bonus, we're going to give you 5 weeks of access to my members only group coaching session. Our retirement coaching group meets every Tuesday at 2 p.m. We're going to give you, during the life of the course, access to that. Each week, you'll be with me while I find, select, and set up our income trades. We'll manage our portfolios. So you'll see everything in action week by week for 5 weeks. Okay. And by the way, if you're new to VectorVest and you don't have a subscription to VectorVest, we're even going to give you 60 days of access to VectorVest for the life of the course. Folks, this is also completely guaranteed. You probably won't need this. I don't think you will. But if for some reason you take our retirement portfolio transformation course and you actually do what I teach you, okay, I don't think you'll need the money back guarantee, but we will give you your money back. But here's the thing: if not if you buy it, but if you actually do it, we believe it'll work for you. So if for some crazy reason it doesn't, and you're like the small percentage that it doesn't work for, and you feel we haven't taught you how to set yourself up for a secure retirement, just send us an email within 7 days after the course ends, and I'll give you all your money back. So hopefully that will give you peace of mind. We're very confident that you'll love what you get here in this course, and you're, of course, not locked into any contracts with us. Do the work. If you're not satisfied, we'll give you your money back. So the total value of everything, you add it all up, $4,300. Here's what I'd love to do. I'd like to give you access to the full course. Right? Our early bird price is $595. That's through today at 5 p.m. Eastern Time. But because you were kind enough to spend time with me today, you can join before the webinar is over. And John and I are going to stay on and answer questions for as long as you guys are in the room here about anything we talked about today, about the course. You will get a $495 price on that. Just go to www.vectorvest.com /transform. John's going to put that into the email bin for you. You could just click on that link and it'll take you right to it, and I'll take you to it in just a minute. But that price is for folks who register today before we go. And if you're an elite subscriber with us, that $495 is actually a couple of bucks lower than the elite pricing. So take advantage of that now. Go to vectorvest.com /transform. And again, that's in the chat box. Just click on that, and that's how you'll do it. There's a saying that the best time to plant an oak tree is 20 years ago, so that you can be sitting under it now enjoying its shade. Well, we all know when the second best time is, right? And, well, it's today. It's never too late to begin to prepare yourself for retirement. I would ask you, but you need to ask yourself, how much did it cost you back in 2000, 2008? How about last year's sell-off? How much did it cost you by not having this information? If it cost you more than $495, then let's fix this once and for all. Let's make it so you never have to experience 2008 again or last year's sell-off again. Let's make it so this is the year you begin to safely grow your retirement and generate that consistent income. Right. So if you go to vectorvest.com or click on that link that John typed in, Go to VectorVest.com/transform, and the details, all the details that you need will be there, and you can sign up for the course. Remember Robert from earlier? He learned this information we teach in the transformation, and then he let us know he realized I could not rely on others and that I had to take personal responsibility for my investments. In March of '09, using VectorVest's unique market timing system with its fundamental and technical analysis uh, techniques, he went into the market and by the end of the year had recouped all of his global financial crisis losses. Okay. So go to VectorVest.com/transform. Uh, that's my plan, a self-paced retirement transformation series. And again, if you order before the end of the webinar, you get it for only $4.95. Okay, remember, VectorVest started in 1988 with the hope of delivering great investing and trading opportunities to Main Street. Over the next 5 years, I'll show you how to set yourself up for a secure retirement. There's a saying that wealthy people spend money to save time. Poor people spend time rather to save money. That's one of the big benefits of this. It puts all the tools you need in one place to save you a lot of time so that you'll know how to grow your account, generating income, and protect your capital. Okay, just go to vectorvest.com/transform. Take a step towards financial independence. We'd love to see you there with us. We look forward to working with you. If you know this is right for you and you're joining me, type 2 words into the chat box for me. Type in "I'm in." I'd love to welcome you to the class, give you a shout out. And now I'm going to take a quick drink of water, and John and I are going to stick around for as long as you want us to. And we're going to answer any and all questions that you have about what I talked about today and about the course. And what I'll do is welcome John to come in and say hello while I take a quick drink. First, before I do that, John, we've got John, Peter, and Joseph all logging in saying "I'm in." Fantastic. Thank you, guys.
Did you?
Go ahead, John. I'm sorry. I was just want to say, and Jay is in as well. Make sure, guys, that you keep your eye out for an email that's going to come and give you all the directions and instructions that you need to access the course. Okay. All right, John. I'm going to take a quick sip because I talk too much, and then we'll answer any and all questions for the folks still in the room.
When you said that, I immediately thought of the apostles,
Yeah,
and
I
I
did.
figured
I
that's the
did.
vibe that you got.
It is. It's exactly what I thought of. That's why I hesitated. We got the apostles here.
Yeah.
It's fantastic. Thank you, guys. All right. So, Cheryl Lynn, thank you. Cheryl Lynn said this is a really well done presentation. Cheryl Lynn, I appreciate that. John, I know you've been answering the questions and you've seen a lot come in here. So I'm going to let you point me towards any questions that I might have missed here.
Sure. Now, for some people took the URS course before. What is the difference between this and that, between this course and that course? And is there special pricing for those that had taken the URS course before?
Yes, first of all, I'll answer the second part first. Yes, if you've taken the Ultimate Retirement Solution course and you're an alumnus of that course, you will get what's called uh, a refresher right there. You should have gotten an email. There's a link there. So that information, if you have any questions on that, you can give product support a call. But if you receive the email or if you have taken the URS course, you're entitled to what we call a refresher price. Okay, so and that's the second part of the question. The first part of the question, there's a few differences here. Listen, the concepts are similar. To, right, I'm not going to tell you it's a totally different concept in the way we do things because it's not. Right, there are some tweaks and changes. It's made better. The investment plans that we use in the URS are very similar, but my job and my desire is to always look to make them better. And so there have been some tweaks to the actual programs and the actual investment plans. Also, we're presenting it a bit different. Instead of one long module, we've broken it down to the important points of understanding the objective, the steps to meet that objective, and then how do you actually implement the plan and how do you implement the risk management techniques, right? So we break that up instead of one long course, and we are going to talk a bit. One of the big differences, and it's not its own module, but when we talk about selling covered calls, we're also, because by popular demand, folks want to know about selling puts for income as well, and we're going to talk about that also. So there are some many similarities, but the presentation is different. There's some new information and some upgrades on some of the plans. Is the difference?
My question I have here is for those that are not in the US, is this course content applicable to them?
It is, yeah. So we get that question a lot. The concepts in the VectorVest program um, is are the same globally, right? It's still the proprietary indicators. Relative safety means the same here as it does in Europe and Canada, wherever else. The concepts are the same. The only thing I will say is when it comes to selling covered calls or selling puts, the only response I have to that is sometimes the U.S. option market is much more liquid than some of the other markets. That might be the only place where it's a little different, but the concepts are applicable to all.
Just a reminder, Jim, for those that just registered, thank you for them. I see a few here. What happens as soon as they register? What do they get?
Yeah, well, you guys again should be looking for an email that will come to you. Give it a few minutes, I guess, at least, and it'll give you all the instructions, the link on where to access the course. And listen, if you are new to VectorVest, okay, and you're here and you want to join and you're not a current subscriber, you'll actually, I believe, get two emails, and one of them will get you logged in and ready to go with VectorVest, and that will come. That one I think is takes a little extra time rather than just getting the course. But all of that will come to you. So keep an eye out in your email bin or certainly in your spam folder in case it goes to that as well. But keep an eye out for that. And what you're going to get is access. Um, Maybe I'll take a moment now and go into it. Let me open it on my screen and let me show you what comes with what you're signing up for here. So I'm sorry, I have like four different monitors here. Let me just sign in to the VectorVest University. You just go to university.vectorvest.com and stay with me. I just need a second to clear mine. My access is a little different than everyone else's here. And that should get, oh, shoot. All right, stay with me. I'm getting there. John, what else are we seeing while I'm typing away here? There we go. Okay. Sorry,
Well,
folks. I didn't want to bore you with all the things I got to do to get here, but I should have had it open. Anyway, we're in university.vectorvest.com, and I just want to show you what the course access does look like to you. Now, this is my dashboard, so I have access to everything. But you'll have retirement portfolio transformation, and when you click there, this is what the course actually looks like, right? So you'll have a let's get started video here. You'll have all of the modules will be available to you. And this is what I was talking about. Under each module, there are different videos that we break it down. Okay, each module has that same thing. If you can't make the bonus of the live coaching group sessions, we're going to put them in there for you. Right now, I believe there are the older versions here, but as we do the new ones, we'll replace them with the current ones, so you will have access even there. And then finally, on the resource tab, you'll see we have all of the uh, all of the slides that you'll need, and we should have some other things here. The spreadsheet should be in here, I guess. Getting started resource. Yep, we have a spreadsheet. We have a covered cost spreadsheet for Module 4. So all of that is available to you here, and that's how you access the course, just for anybody who's wondering there. What else we got, Johnny?
Hey, hey Jim, what about the dates for any and all live sessions, and what is the difference between live sessions and the sessions that are already uploaded as pre-recorded?
Yeah, so the idea here is what I'm showing you here are the modules. The difference between a module and a mastery session is the module is where we actually teach the content for the course. Okay. The mastery sessions are live and they will begin on they're going to be every Monday at noon starting okay starting next week. But because September 6th, which is Monday, is Labor Day, that first one is going to actually be on September 7th at noon, which is Tuesday. Moving forward from there, it's going to be every Monday at noon Eastern Time, moving forward for the rest of the mastery sessions. And it's in the mastery sessions that we take what we learned in the module and actually apply it, right? Actually use the techniques. Also, we use it to answer any and all questions that you have about the module's content. And again, if you can't make the live session, remember later that afternoon, we record it and we archive it right in the uh, the university, so you never really miss anything. And also keep in mind you have access to this for 1 full year after the course ends. So keep that in mind as well.
Excellent, Jim. I have a question here asking, what is the portfolio size that you would need as a minimum?
Well, it is a question we get a lot. And listen, if you're building and managing your retirement portfolio, it's all relative, right? It's hard to say how much do you need to do this. Now we are talking about building a dividend portfolio or a growth stock portfolio. So just keep in mind it's hard for me to put a number on. Somebody asked me the other day, is $25,000 enough to do this? And my answer is it absolutely is, right? We can be, again, because it's all relative. If you want to go out, depending where you are in retirement, you may say, I'm going to go out and build a dividend portfolio and I'm going to buy, say, 5 stocks, that are good quality dividend portfolios where I can get capital appreciation and a steady income. Is it harder to implement all 3 strategies at once? It might, yeah, sure. But you don't have to have in place all 3 going all at once. Some folks choose just 1 or 2 of them. Some folks will employ all 3. It depends. So yeah, it's a difficult question to answer, but certainly I'll use the $25,000 number, 20,000. You can do it there without a doubt. John, I see a couple of these questions. Let me just address the pricing of this. If you're an elite subscriber, order now and you save $2.50, Dwight. That is correct. 490. The actual price of the course is $9.95. Right. If you sign up, say sometime late Tuesday, it's going to show as $9.95 to sign up.
And just to clarify what Dwight's question may be, if you want to get that 495 price, when you use the link here, do not log into the button that says Elite. You'll simply go direct into this transform link and just log in as is from that link. You won't go into your special Elite section, if that makes any sense.
Right. So what John's saying, yeah, if you're an elite subscriber, don't click on that if it offers you that. Just follow the process to sign up. All right. Um, let's see. I'm trying to figure out what else I can show here. If there's any other questions, anybody else who might have gotten in, let us know that you're in. If you're having an issue, let us know that also so we can make sure you get in there. Steven says, how about my question? Steven, do me a favor. Type your question in again because we have a lot scrolling through here. I'm certainly never going to skip a question on purpose unless it's really out of left field. But if Stephen, if you, oh, there it is. If we're most interested in a swing trading scenario, will this course help us? Or just long-term income? Stephen, because I will never ever lie to you or mislead you, uh, there's nothing we do that is swing trading. Here, we use the confirm up calls to enter. We use prudent slash conservative exit strategies for our dividend portfolio and our ruler stock portfolio. The closest thing to swing trading, though, Stephen, I will tell you, is again, and you'll see it every Tuesday in our coaching group. We do the buy rights, right? We do. That's the closest thing we get to actually what I would put a trading moniker on it. Right? We don't trade in our growth portfolio. We invest. We don't trade in our dividend portfolio. We invest. However, the buy right portfolio, the income portion of selling covered calls, would be the closest thing we get to trading. So, Stephen, hopefully that helps you. I'm certainly not going to. I want you to join, but I'm not going to mislead you here. Elizabeth, I know John just typed in there, but when you say a current member, that is
I,
if.
I, I s- I saw the question she had asked earlier because she took a different course.
Oh, I got you.
She's
Okay,
confusing, yeah, she's confusing
okay,
that with the refresher pricing for a person that took the URS course.
got you. Okay,
Yeah.
thanks, John. I'm sorry. I never know if that's part of a longer conversation there. That's why I butt in there. Is it Bulent? Hopefully, I'm pronouncing your name right. How do we manage the earnings when we have a dividend portfolio? Well, I can help you with that. Bulent. What we do is we often will go in and um, talk about what we certainly do in the course and in our retirement coaching group, how we manage our portfolios is we do keep an eye out for when earnings reports are coming out. Now, I will tell you this, I'm a little less worried about the quarterly earnings on my dividend portfolio uh, because I am in it for the longer term. And the stop criteria is, fairly prudent or conservative. I'm a little less worried about drawdown in my dividend portfolio. But whether it's dividends or growth, what we're going to teach you in the course is the ability to place not only the put option on the SPY that we talked about, but how you can place trades on individual stocks to protect for earnings reports most specifically. We do what's called a collar trade. That's a combination of selling a call and buying a put. We talk about just buying puts. Okay, so we do address that how to manage individual stocks as well as the overall portfolio. Uh, as we wait again, we'll stick around, John and I, but I see a question from David. Give me a second just to go through. On the graph, I saw the complete portfolio was sold in March of 2020. That's right. Our stop criteria had got us into cash. Um, are you also then at that moment buying a put as an insurance because there's only cash at the moment? Good question, David. The idea would have been to buy that put option well before all of our stop criteria was hit. Remember, we had a DEW down in February, and then 4 days later of 2020, and then 4 days later our confirmed call came, and we didn't have our positions sold out there um, until March. So it is possible that both can be in place. That our stop criteria would still be closing positions, but that the strategic defense would also be mitigating those losses. So as I talked about briefly, the idea that these portfolios, I'm in a I'm in a different account. I'm sorry, I don't have the port. This is a different account. The drawdown that we saw would definitely be mitigated using our strategic defense. Good. Hopefully that helps, David and Bullet. Hopefully that helps. Who else is in? Anybody else type in I'm in? We want to make sure you get that email and that you get all the instructions that you need. How many positions lines will you have in your portfolio? Too many become difficult to follow. David, we set up our portfolio. You're never in any one portfolio. You're never going to have more than 10 positions, right? So our growth and again, it's up to you. It depends on the size of the portfolio. You could go with 5 positions in each, 10 positions. In the dividend portfolio, you can go to 15 positions. But please remember, I know you said you have a good point. Too many becomes difficult to follow. But you have to remember, these are not trading accounts, right? There's not a whole lot of trading done in these accounts. They're prudent stop criteria. Okay. So they're not hard to manage once you have the management techniques in place. Delton is in. Thank you, Delton, for joining. Also, I see Mike is also in. Thank you, guys. I look forward to working with you. Again, keep an eye out for the email. And if you don't see it, give it a little time to get there. But if you don't see it, check your spam or junk folder as well. But it'll give you all of the instructions you need. And you'll have access to the course right away. Once you get the email and check in, you'll have access to all of the resources there. And then remember our first um, mastery session will be Tuesday the 7th because of the Labor Day holiday. Now, also on that day will be the first coaching group session you'll be invited to as well. So, big day then. Hi, Ray. Ray says he is also in. Welcome, Ray. Glad to have you. We look forward to seeing you again in the course. Keep an eye out for that email. You'll have access today to everything. And, if there's any questions, of course, you can always call our product support folks and they'll be happy to help you. All right, I'm going to give it just another couple of minutes in case anyone's trying to log in or has any other questions. If you're having trouble getting in, let us know. We'll stay just for another minute or two before we wrap up. I'm trying to think if there's anything I missed, but I think we've got it covered pretty well. Mike says, what VectorVest service do I need to get in addition to the course? Well, Mike, if you're a new subscriber to VectorVest, we're gonna give you access to the VectorVest program, the intraday software, for 60 days for basically the life of a little bit longer than the life of the course. Afterwards, here's the answer. I think that's the most honest, the fairest way to answer you is once the course is done, you will have access to the course for a full year. If you're new to VectorVest, you'll have 60 days access to the software. And then if you want to continue with the software, you'll need to subscribe to it. If you choose not to subscribe, can you still implement what we do here? You can. You're just going to miss out on the great information and guidance that VectorVest gives you, but it doesn't mean you can't apply the concepts that we use. VectorVest will make it better, but you don't need any additional software to the VectorVest, the basic VectorVest 7 program, if that's your question. There's no add-on modules that you'll need to be successful. So hopefully that helps. Okay, good. Fantastic. All right, John, what do you think? Give him 30 more seconds. Any questions? Anybody else in? Let us know. Otherwise, I'm going to go ahead and log out of here in just about another minute or so, 30 seconds or so. In that time, I would like to thank you all for taking the time to join us. For those who are still here, if you're still considering joining, you can still go to VectorVest.com/transform if you decide later on that you want to join. You still get a great deal at $5.95. So I would hope to see you in the course. If not, hopefully we'll see you next time. And so on that note, on behalf of John and myself, thank you so much for taking the time to be here. That $4.95 price will be available to you for a few more minutes, but I'm going to go ahead and end our webcast here. Thank you all. Stay safe, stay healthy, and we'll see you next time. Bye for now.